We taught during the Chapter 3 lecture about how there are variable cost and fixed costs. And we said that those were going to be important distinctions as we move into Chapter 4. So we're going to start with comparing traditional income statements with contribution margin income statements. And those words variable cost and fixed costs are going to come into play right away. As a review, I put up the traditional income statement. Sales, cost of goods sold is taken away from sales, and that helps us determine gross profit, sometimes called gross margin. So if you're used to that term, it's synonymous. They're the same thing. From gross profit, then you have to take away your selling expenses and your administrative expenses to finally get net income. So hopefully you sold your products for so much, such a high value, that you were able to cover the product costs, the direct materials, direct labor, the overhead, all that stuff that goes into cost of goods sold, have money left over that could then be used to cover all those selling expenses and administrative expenses, and still have money left over that we would call profit or net income. Could be called net profit, gross profit, net profit, but for whatever reason, accountants like the term net income instead of net profit. Contribution margin income statement is another way to show the income statement. This is not something you're going to see in the published financial statements of a company, but it is something that's used in internal planning. Still have sales as your revenue, but instead of taking away cost of goods sold, we're going to take away the variable costs. We're going to call the difference. Sales minus variable costs is called contribution margin. It's what's left after you cover the variable costs. Those variable costs are going to include direct materials, direct labor, variable overhead, just the variable part of the overhead. And this is where it's strange. Variable selling expenses, and variable administrative expenses. So all the variable costs, it doesn't matter if they're a product cost or a period cost, they're included in the contribution margin income statement as the variable cost. Oftentimes our problems will talk about these in a per unit rate. We sell the products, let's say for $100 per unit. Variable costs, all these things at a per unit cost, like we were doing in the cost formula in the last chapter, let's say are $40. So we sell it for $100, $40 out of that $100 has to go cover the variable costs. So our contribution margin will be $60 a unit. We could even insert a per unit. And say $100, $40, $60 would be the contribution margin per unit. Then we have to do all the fixed costs. And again, this is all the fixed costs. So it'd be the fixed overhead, the fixed selling expenses, the fixed administrative expenses. And these aren't in a per unit amount. If the contribution margin is big enough that there's money left over after you take away all the fixed costs, then you have net income. So our income statement is going to include, let's slide this over here and let it wrap a little bit. We'll merge all those guys together and wrap them. So the story's there, but we're not worried about taking up too much space. Here we could do total. So if we sell a bunch of products, let's say we sell 100 products. We bring $10,000 as sales, 100 times 100. 100 products at $40 a piece would be $4,000. So we have $6,000 left to cover the contribution, to be as a contribution margin. That's what those products are going to contribute towards the fixed costs. Now the question is, how big are our fixed costs? And since I can make up the problem, I'm going to make it up so we're profitable. So we're going to say that our fixed costs are $4,500. Then our company would have $1,500 of net income. So that's a contribution margin income statement. Instead of having our product costs all lumped up here as cost of goods sold and our period costs down below as selling and administrative expenses, we're going to break the two components up as variable and fixed. But I want you to notice that no matter which way we did it, our net income would come out the same because we are still taking away our product costs and our period costs, just which category at the end, but the same things are being taken away in both statements. So why do we use this? Why do we care? We need to budget or figure out what it would take to break even. I'm going to talk about what break even is. Okay, my layman's language. Break even is when the income statement, the contribution margin income statement, or the traditional one, but we're going to talk about it as the contribution margin one, comes out with zero profit. So let's take a look at that. I'm going to recopy it down here. And we're talking about the moment at which we would sell just enough to get zero profit. We don't know how many we're going to sell, so I'm going to take away all these numbers because we don't know at this point how many we're going to sell. We do know that we sell each one for $100. $40 covers all those variable costs. So every time we sell a product, it puts $60 in the pot of money to build up to cover fixed costs. So break even is when contribution margin equals fixed costs. If you think about that, that's going to make sense. We want to find the point right here where there's enough contribution margin to exactly cover the fixed costs and have nothing left over. That's the definition of break even. Have no profit. So the formula to do this is to take your fixed costs and divide by contribution margin per unit. So for us, that's $4,500 divided by $60. And that's going to come out to 75 units. So let's see if that works. If we sell 75 units, what will our sales be? Well, they would be 75 times $100. Our variable costs would be 75 units, each one being $40. So 3,000. And if we subtract those two, as you can see, that's going to come out to exactly 4,500, just enough to cover the fixed costs. Okay, sorry, take a break for a second there. So we have our break-even point figured out. There are times when the story problems will ask you not how many units do I need to sell to break even, but how many dollars of sales do I need to bring in to break even? Kind of a technicality because they're very, very similar answers. So let's take a look at that. How would you do that? One of the things you have to do in order to do that is come out with a let's see where I can do this. It's gonna, let's move over and use a little different space. And we're going to create an additional column. This is going to be a percentage. So variable costs, you can see it as what percentage of the selling price? It's 40%. We made the numbers really simple so that it would be easier to figure out And we're going to turn all these into percents with no decimal places. And we'll do the same thing here. Contribution margin then is 60% of the selling price. So the formula to find break even in sales dollars, so where your answer is how many dollars of sales do I need to have to break even? The formula is, again, the fixed cost. So we're always trying to figure out what fixed costs it's going to take, what contribution margin it's going to take to cover those fixed costs. But then you do contribution margin, not per unit, but contribution margin percentage. So it's our $4,500 of fixed costs divided by our 60% contribution margin ratio, and that's going to come out to $7,500 in sales. I know you're probably saying, why do I care? I could have done that here and figured out it was going to be 7,500. These formulas will get you the same answer. One just directly tells you the number of units, and the other one directly tells you the sales dollar. But from one, you can get to the other one easy enough. So what do companies use break-even for? To help them plan. If they're going to talk to their marketing department and say, if we're going to run this product, given what I'm seeing and all the numbers, we're going to need to sell at least 75 of them to make this thing even break even. So more than 75 is going to give us a profit. Marketing can come back and say, there's no way we can sell that many. So it doesn't look like this project's going to be feasible. Or that's easy enough. We can do well over 75. So it helps them budget. One additional thing that you're going to see in the story problems, and we're going to stay with the finding the number of units for a while here. Let's say that we have a story problem and we're asking ourselves, how many units do we need to sell? So we're back to this kind of story. But this time it is not to break even. It is to make a certain amount of profit. So we're going to say that our company would like to make $1,500 in profit. We're trying to find how many units they need to sell in order to both cover the fixed cost, which is break even, and have a profit of $1,500. So our formula changes just slightly. The top of the fraction is fixed costs plus the targeted profit. And all that is divided by contribution margin per unit. So we're still dividing by $60. We're just adding together $4,500 and the $1,500 of targeted profit and dividing the whole thing by $60 or $60 per unit. So it's 6,000 divided by 60, and as you can see, it's going to come up to 100 units. So it says we need to sell 100 units in order to achieve this. Whenever you do the formula, it is very much worth it to run it through the income statement to see if that truly comes out. So $100 a unit times 100 units would bring us $10,000. That's the way we started the story problem in the beginning. Remember when we were just giving an example? And then if we had sold 100 products, we would have to pay $40 of the selling price over to covering the variable costs. That's going to take 4,000. So 10,000 minus 4,000 gives us 6,000. 6,000 covers the fixed costs and has exactly 1,500 left over. So that is finding the amount we need for a targeted profit. And most everything that we've just talked about is in our chapter. I think you should be pretty set to work on the story problems in the chapter and do the homework. Most all of them are going to be figuring out some component of fixed variable costs, break even. Some may just ask you to determine the contribution margin. maybe the contribution margin in percentage. Some will ask you to find the number of units it takes to break even, or the sales dollars it takes to break even. And some will throw in that little component of, oh, I don't want to break even, I want a targeted profit amount. So work through all of those. If you get into ones that get confusing, reach out and we'll work on them together. We can meet like this in line and put the whiteboard up and solve the problem together, or example problems like it.